Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to check out Twitter, see what people are talking about. It's going to be going over wealth related, financial related, and commodity related topics. I think the opportunities right now are in commodities. Obviously, there's other opportunities too. I think healthcare looks good too, and there's other areas that you can make money in if you just stay long for a long enough period. But commodities overall look very enticing, look very good from a short term, medium term, and long term perspective. So let's dive in. Let's see what's going on in the markets, and I'll give you my financial opinions. Again, you can follow me at finding_finance. If you want to join our community, finding-value.com, you can join there too. There is a discount going on right now. It's in the description link below, and that is 50% off the first month if you want to try it. And it is September for the coupon code. So, Dividology. He says growing free cash flow every year is one of the most important things a company can do. With it, they can reinvest for organic growth, attempt mergers and acquisitions, pay down debt, pay dividends cash, buy back shares. He says organic growth mergers. So he goes into all these. What I'm going to tell you guys, in your own portfolio and in your own life, one of the goals that you can have is growing free cash flow every year as one of the most important things you personally can do. And what can you do with that cash flow and money? You can reinvest for organic growth. You can pay down debt. You can invest in dividends to increase your cash flow, and you can buy more shares. That is exactly what you want to do in real life. Now, the way that you want to measure free cash flow is look at your expenses, look at your top line revenues, and try to maximize your free cash flow to invest to get a snowball effect. That is how you get ahead. And if you can snowball your dividends to a big enough level, well, then you don't have to work anymore. I mean, that's the end goal. How much money that is, I don't know. I mean, I guess a lot of people who are close to retirement probably ask themselves that question a lot. How much do I need? What type of dividend should I have? What's my dividend growth rate? All that stuff's important. But I think we should run our balance sheets just like a company, and I think you'll be doing a lot better. Here's Sprott Physical Uranium Trust, 15-year high close, and we're just at the beginning. Got uranium. Look at this, guys. This looks fantastic. Big long-term view. You got that line going across, which is a resistance line, and we're breaking out. Looks absolutely fantastic. How high are we going to go? Don't know yet. And how fast are we going to get there? I still don't know that either. We could really break here. And what I do in these situations is I buy my equities and I just sit. I sit in all types of these types of setups. There's setups in energy service. There's setups in oil and gas. There's setups in copper. They're all over the place. And all you do is you buy in a good ideal location, like 2020 was a really good spot there, and you just keep holding on. We have a good breakout here. This is usually a good spot even where we're at for some of the equities. The latest housing data shows that home prices are now back up at all-time high levels. Higher rates are having an inverse effect on price. Rather than prices falling with higher rates, they're actually rising. Why is that happening? As rates rise, existing home sales are falling, now down 16.6% at their lowest since 2010. Borrowers are locked in to sub 3% mortgages and do not want to sell their homes to get a 2.5 times higher rate. We need lower rates for lower prices. Truly a historic occurrence. What I'll say there is false. False, false, and more false. What happens is you get a demand-supply imbalance in the market. which is a deficit. You get a deficit in homes, and then home prices go up, inventories go to very low levels, and then a whole bunch of new homes are built. That's exactly where we're at. We're right at the beginning of an expansion phase of real estate. The interest rates chase that inflation that is coming from the loans and credit creation against the new homes. So the people who thought that when interest rates go down, home prices go up, they don't know what the heck they're talking about. That is not how the cycle operates. The cycle operates where low interest rates are where you get low home prices and low interest rates in a glut market where you have a lot of credit destruction. All of that unwinds, and that's the bottom, known as the bottom of the recovery phase. As you go to the expansion phase, interest rates go up, new home sales will increase, and the interest rates may or may not bring down home prices. It depends on your inventory levels. Now, I don't think that lower rates would result in lower prices. I think that is wrong. I also think that these borrowers that are locked in sub 3% mortgages, that doesn't matter either. If they sell a house, they generally have to buy a house. It's a one-for-one trade. It's not we gain inventory. So I think that's also a false statement in here for the majority of deals that would be made. I do think there's some false claims in this one. And it is going back up. It does look good. Coming down, would you ever consider getting a 15-year home mortgage? So 15 versus a 30-year mortgage, loan amount 325. If the interest rates were this high, I would pay it off as quickly as possible. Now, I know people are looking at the total here, the 784 and the 507. What I would probably do is not refinance to a 15-year. I would probably keep it on the 30-year and pay it off as quickly as possible. Why would I do that? Well, if I ever hit a problem, I would have a lower payment that I could meet and stay in the game longer. But most of the time, you can pay a 30-year loan off much quicker. So the way I would do it is I would try to pay it off in 10 years even, and get rid of a 7% or 6.43% interest rate loan. I would just try to pummel it down to nothing and then own the house. That's what my plan of attack would be with interest rates this high at 7.5% or 7%, 6.5%. At where I'm at 2.75, I'm not going to pay it off early. It's below the rate of inflation. This here, you're probably pretty close to the rate of inflation. So it's better just to pay it off, in my opinion. And then the 15-year, depending on what your interest rates are, that could be a substantially larger payment. So just be careful with the payment size because you don't want to bite more off than you can chew, because you don't want to choke on these payments. So what perhaps one thing that you could do is if the payment is real tight over here, you could just do the 30 and pay it off as fast as possible. That is a potential that you could do. And if you ever had to revert back to the 2180 payment, you could do that. Eric says, we remain bullish, though the total global oil held in inventory, this is his forecast, guys, it's just straight lower out into end of 23 and 2024. And there's a forecast here. It just eats through inventory. So that's global observable oil inventory, onshore and oil on water. That's what it looks like. So that's crazy. And prices will go up if inventories go down like that. He says, many hate their jobs. They spend all their money on things they don't need to fill a void. It makes them become a slave for the next paycheck. For most, this cycle continues for 40 plus years. How do you plan on escaping this cycle? Well, my plan is to absolutely tear it up in the commodity bull market and disrupt that cycle in its entirety, where I don't need a 9 to 5 job. That those commodity earnings or those winnings or the investments that I make, hopefully they play out the way I think they're going to play out, and then I'll invest in dividend-paying companies where I live off the dividends. That is one of the strategies that I'll deploy. I am investing actively in more dividend-paying companies today. I still play with some of my money in the dividend-paying companies. The way I break up the portfolio, I do include, housing because it is an expense and it is an asset slash liability, however you want to look at it. There is equity being gained in housing, but housing's, I don't know, maybe 20 or 30% of my portfolio. Physical precious metals, I try to hold it around 30%, playing the ratio game, where I invest in the low ratio and swap when the ratios are favorable for whatever metal's favorable. So that's 30%, and then the rest is in equities. In retirement accounts, I do have an individual account, and then I get dividends. I play the dividend game where I'm trying to snowball dividends in all the accounts. Roth IRAs that I had opened up a long time ago, and health savings accounts, and 401ks. And then I also play the speculative game to some degree. Not as much anymore, I should say. There are smaller positions. I try to play the cash flow game where you find companies with a bunch of cash flow, growing cash flow. They got the infrastructure to really take off. And if we get, 200, 250, 300, $400 oil, I mean, those companies are going to be making some serious, serious cash flow if we get up that high. Grady says this ratio chart shows really how undervalued copper is and how overvalued the NASDAQ is. A shift towards hard assets is coming. The chart now has clear red positive divergence as it had last time it moved. So here's your double bottom. There's your lead-in pattern. I call that the lead-in, and then that's where you put your line across. So this is a perfect double bottom where we're right here about to turn up. This is absolutely ridiculous where we're at, guys. To even identify where we're at in this ratio and to identify it as early and as low as we're at is ridiculous. I have a feeling that commodities are going to do some crazy stuff here. We could be at an end of game type resource problem in the world or Earth. Maybe, I don't know. Where we go all the way up and everything that's valuable is it's just companies fighting for resources. With each other using money. And that's a whole bunch of different resources that are all looking like this. Silver's like this, gold is like this, copper's like this, oil's like this too against the NASDAQ. They all have this double bottom. And we have a long way to go higher. Here's kind of zoomed in on, this is the silver to S&P 500, and it's the second big backtest in the making, but here we are, guys. We're right here. We've broken out of the falling wedge. Let's get this thing rolling here. With metals outperforming general stock market, global capital is flowing into the precious metal sector. Totally agree with that. Totally. The final and third gold bull run since 1971 is soon upon us. These are generational wealth-creating moves, not to be missed as they are life-changing opportunities if played right. So in a resumed bull market, there's always the next resistance until there is not. And then here is the big potential bull market. And if it does go up vertical like that on a kind of an exponential move, I mean, you're either in this stuff or you really are not in it. Like, you're going to get left behind. So this is a red parabola. Line fits perfectly, and the time frame makes complete sense for a move like this. Correct. And look at the logarithmic on the right-hand side, guys. This is going to go up to like 20, 30, 40, 50,000. I don't know what it's going to be. It's going to be ridiculous. Australia's grid operator is warning of energy shortfalls over the next decade as the nation retires 62% of its coal power fleet. Yep, there could be, and that's going to slow down some of the mining companies. Hedge fund exposure to mega cap technology stocks just crossed 30% for the first time in history. There's never been more hedge fund exposure to large technology stocks. Institutional money really believes that AI is the next big thing. Will AI live up to its hype? No, it's not. It's a bubble, guys. This is what a bubble looks like. Going into one. Now, the bubble can keep going up. I'm not doing anything about it. I'm not jumping in front of this momentum or train. It can definitely go up higher, but it is a bubble. Silver shorts are getting nervous as a clean break above $25 will result in a deluge of short covering and massive squeeze higher. It is coming. Be patient. It's coming, guys. Cuppy keeps making new highs and no one cares. That's how you want these bull markets to go. Silent, relentless, sneaky. Never letting anyone in with a pullback. He's talking about uranium. Uranium oxide U3O8 and how we just keep working the price higher. We're in the 60s now. We're mid 60s. Have you ever picked up on any red flags while interviewing for a new job company? I remember one manager saying he didn't like remote work because it reminded him of retirement. No thanks. You know, I'm trying to think of any red flags. There's some things that occurred over the years. I thought they were kind of weird, but it's nothing really worth mentioning. I've interviewed with a lot of large corporations, and there were some small ones that I also interviewed with. I didn't think there was any like massive red flags. I can tell you red flags when people try to sell you something. I just went through a bunch of quotes for windows on the house. These guys try to pressure you so hard into making a decision when they are here. They're like, well, we can lower the price to this, and this is your last time to sign it for this price. Sign it today to get the sale now. They must have run the statistical analysis where if you don't get the sale in the first meeting, the chances of getting that sale must rapidly decline to some extent. If you know that statistic, put it in the comment section. I'm interested to know if somebody knows that statistic where if they don't sell you when they come into the house the first time, what's the likelihood that that person's going to come back and actually buy? I'd like to know that. But those guys, there's red flags all over the place with those guys that come out here, those salesmen. Man, they're trying to sell you no matter what. So that's the red flag that I see. The fear of peak demand fueled by energy ignorance is leading to the reality of peak supply. So liquids demand driven by transportation and chemicals by region and sector. Million of oil equivalent barrels per day, 2050. And there's that going on up. So liquids demand is definitely increasing. What they said is chemicals and commercial transportation account for almost all of the liquids demand growth, with chemical expected to increase by around 80% from 2021 to 2050, and commercial transportation to increase by approximately 45%. Cuppy Gang says, well, here we are. Physical is a tick from 60, and it did pass 60 already. And uranium CN is just under 20 bucks. I'm ready for the horde to wake up and stampede in a few more ticks. As was prophesied, said in my blog on the breakouts. So he's just waiting for the herd to come running in here, guys. That I'm positioned. I'm ready for this. Let's let this thing rip. Here's silver in world currency units. It's happening right under our noses, and most haven't even noticed yet. Now's the time to prepare for what is to come. Here's our breakout in world currencies for silver. We've got a big move coming up ahead of us for that silver move. URA and the Renko chart. Mr. No Noise Renko is confirming what we are looking at. A massive breakout for uranium miners. We're starting to break out here on the Renko charts. Perfect. More global oil inventories just dropping 10 million barrels away from the record deficit set in June of 2022, which reversed solely due to the largest release from strategic political reserves in history. So guys, we're entering this SPR release. We're entering the lowest inventory levels, and that was back when oil was 120 plus. I think we're going back up there. It's just going to be a little bit of time. Uh, yeah, I'm going to end it there, guys. I'm going to end it there. So that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like to join our community. Again, we've got a 7 a.m. Mountain Standard Time on Saturday coming up for the question and answer session. Love to see you there. And we do have a discount going on September for the monthly membership to get 50% off if you want to try it. All right, guys, that's what I've got for today. We'll catch you guys later. This is Finding Value.